Good morning, ladies and gentlemen. Well, we are still likely to find very little of use from the risk dial. It will just keep on going higher mathematically because the averages are going to go higher, so very little use from this. I really thought I would take this opportunity to examine what we are actually waiting for to bring clarity to the situation and find out where asset prices are going to trade over the course of the next several months. We have a new administration taking office, and what we really need to find out are its policies towards primarily the issuance of bonds, and that will determine where risk premium and where real rates are, and therefore where other assets can trade against bonds. The next quarterly refunding is February the 3rd. Now, I just don't know if the new administration under Besant at the Treasury is going to have enough time to decide what to do or change anything at that quarterly refunding. The one after is 3 months later. So maybe they will have time, maybe they're already deciding which way they want to issue, but that, I think, is the first really important date for bonds, apart naturally from the FOMC, which is going to be the 17th and 18th of this month of December. So let's examine what the dot plots can be and what that means for the terminal rate. But I just don't think that the Fed is going to be in a position to change things dramatically in its monetary policy until it's found out what the Treasury wants to do on the issuance side and what the new administration policies are going to be for immigration and for trade policy especially. I keep on looking at these charts of the term premium and also of the real rates, and my conclusions are that until and unless we see what the Fed decides and, more importantly, what the Treasury decides, we are unlikely to come out of this range. We are actually a little bit lower in term premium because this last updated November 22nd, we actually finished the week here, around just below 50 basis points, let's call it 45. And we are likely to repeat something like here. We are in a sideways mode until we see the new policies. And the real rates, I think, are very, very unlikely to go above this level of 210. We finished somewhere around here, around the 190, 191. And that seems to be reasonable for the time being. I can't see that the market is really going to start pushing higher until and unless we know what the Fed wants to do and what its SEP plots are, the summary of economic projection dot plots. And I don't think that they can come up with anything meaningful or informed until they've seen what the Treasury wants to do. Does the Treasury really want to ramp up supply of longer dated issued bonds rather than continue with the policy of Yellen of issuing mostly bills? They've made noises that they might want to do that, but I just am very skeptical they're going to have the time to decide before that due date in early February. So I think it's unlikely that bonds feel a lot of pressure, and that is probably why last week they rallied a little bit. Let's have a look at what happened last week, but let's have a look at it at the spread to Europe, because that really is what matters at the moment, I think. And bonds are unlikely to be able to move completely by themselves until we know what the new issuance policy, if there is a new issuance policy from the Treasury, is. Now, there is no denying that a 20 basis point plus move in the 10-year note for 1 week, and especially a holiday shortened week, which was thin, is quite significant. And we also had a lot of issuance, and especially in the 7-year, which is exactly what the duration of the 10-year is. So is it significant that we moved so much? I don't think it is, simply because on a spread to actually Germany, we moved nothing at all. And I think it matters where the other markets trade for where the US trades. Now, what happened to the yield curve? The yield curve did actually very little indeed. And if we look at the 2s, 10s, here we are. We basically closed exactly where we opened the week before. I told you that the spread, or rather that the yield curve flattening, is likely to continue until we see the new plots from the Fed. I don't think there is any impulsion to steepen the curve at the moment, and when there is no impulsion to steepen the curve, you tend to buy things which have less negative carry, and that is the longer end. So at the moment we are in limbo in 2s, 10s. We are probably even likely to go up to 0.5 or something like that. But the one which is more important is the 5s, 30s, where we did absolutely nothing. So anything with any duration to it, like the 5s, is not moving against the 30s. We are, in limbo, and we got out, and now we are looking for the Fed signal to get back into the steepeners. But this is going to take some time. It's not until the 17th, 18th, and until then, what are we going to do? I think we're going to move sideways. If we see this 18, 19 level, I think it's going to be an excellent opportunity and excellent risk reward to put on a steepener, but not before then. So let's have a look at the 2s. Why can the 2s really not move at the moment and go and lead? Well, they can't lead because we don't know where the terminal rate is. We don't know what the SEPs are going to be from the Fed. It is reasonable to me that we trade in a range between 4.05 and 4.30. I've always told you that this 4.42 level was probably a bridge too far and an excellent risk reward to get long of. Now, the market never quite got there, and, as is the way, when it doesn't get there, it goes to the next support. The next support is around here at 4.05. I don't think that we can break this 4.05 before the Fed. I really don't. And that, unless the yield curve is going to flatten considerably, and I think it's going to flatten a little, 4, 5, 6 basis points, is really going to be the bottom for 2s. They're very unlikely to go through it unless we start speculating that they're going to do a 50 basis points at the ECB, which is a few days earlier. I think the ECB is the 12th, while the Fed is the 17th, 18th. But only if the ECB does 50 basis points can we start going through 4.05 in 2s. Let's have a look at Germany. There is some speculation of a 50 basis point cut. JPM called for it on Friday, I believe. I don't believe they're going to do 50 because I don't see who is going to advocate for a 50. The Germans are notoriously hawkish, and they're the ones with a problem. The only ones who would advocate for it are probably the French. But let's see what they do and if they get enough support at the council. To me, this just below 2%, this 190 level is important, and that is where I would be awaiting the decision, i.e. not through a 50% probability or a 60% probability that they cut 50, because that will probably be too much. But what is important is that the curve, just as I told you last week, has stopped its steepening bias and it's now slightly flattening, simply because people are saying, well, do I really want to put all my bets that they do 50 basis points and they keep on steepening? No, I'm going to buy a little bit of duration just in case. So let's have a look at the Bund, and this is approaching very, very important levels. I think that we definitely try this 201. We might even try 194, but I don't think that we go through it. I think it's far too early to do that before the ECB. We might push for these levels, but I don't think that we, hold them. What is important is that last week's move in the US was actually led by the bunds. All these markets are interrelated, and the fact that the bunds came off the best part of 30 basis points, right, 22 basis points, moved the 10-year note as well. And why did that happen? Well, that happened because of where the spreads are. And this is where the spreads are. You can see that this area, it's not going to be easy to break above this 220. So the fact that we just went sideways last week in the spread between the 10s and the Bund makes sense to me. We have come up an awful long way. We've come 60 basis points in a couple of months, and this spread doesn't move all that far that fast. These are developed markets, very deep, very big, and to get them through these kinds of levels, you need to have a very large policy change. And we don't have a policy change. So it's going to be very, very difficult for this to go through. And if we look at the twos, that is at an even more important level. I told you when it got to 235 that this was not good risk reward, and that is precisely where the dollar peaked. We are in a holding pattern until we see A, what the ECB does, B, what the response of the Fed is going to be, and also C, until we see what Besant wants to do with the issuance. Because this spread can only start moving out significantly, and especially the 10s, if Besant changes policy. If he changes policy and starts issuing more duration, what is going to happen? Well, first of all, you're going to have the term premium explode higher, real rates go higher, probably to around the 250 area. I very much doubt they can go through 250, and that is going to make this spread explode through 220 and probably achieve this kind of level, 235, 240. That is what is going to make this spread explode and consequently the US dollar. But I don't think it happens before we have seen all the ingredients that I've mentioned, i.e. at the earliest in very early February. It's going to take some time. We need so much more information before we can decide that we belong trading up here. So I don't think that next week we're going to have big moves in anything. I think it's much more likely to be consolidation and awaiting for a NFP, which is the last NFP before the Fed decides. But I don't think the NFP is likely to be weak. We haven't had a single weak employment data point at all. Why should the NFP be weak? It doesn't make any sense. Which basically means that I don't see a continuation of the rally next week. We might go a few basis points as I showed you, but I think we back and fill at some stage. As a last chart and last triangulation, I want you to look at the 30s. So this is the US against Germany. We are just holding these levels. And let's have a look at this chart going all the way back to God was a boy. And you can see how important this 216 level is. If we take out 216, that means that there is a big move underway in duration between Germany and the US. And that is unlikely in my book to happen until all the unknowns that I've mentioned are known. It's very, very unlikely. And that to me says that wherever duration is in Germany, it'll be almost matched tick for tick in the US at the moment. If you look at what the curve did in the US last week, everything from 5s out to 30s moved in parallel. And if you look at what happened in Germany, everything 5s out to 30s moved in parallel. And the spreads of the duration, of the long duration, basically stayed absolutely still. That tells me that the US and Germany at the moment, at the longer end, are tied together. They've reached levels which are pretty extreme, and for them to go further, they need information. They need to know what the issuance policy in the state is. They need to know what the Fed's dot plots are. They need a lot more information, and they're not going to get that for a couple of weeks. And that means that for the next couple of weeks, I see these things trading tick for tick in terms of long duration. Wherever Germany leads, the US is likely to follow. One last word about the extreme short end of the US. We have gone from basically trying to determine a terminal rate somewhere around 3% or even lower to now trying to determine a terminal rate of around 3.5 to 3.75, maybe even 4%. And instead of having cuts at every meeting, we are now pricing in cuts at every other meeting until basically September, and then we are not pricing in any more cuts. So we're pricing in 1% over the course of the next year to take the terminal rate from 4.5 now towards 3.5 in a year's time. When that happens, the yield curve will just go positive all the way. So to me, that September-December spread still makes sense, and you still should buy it. Every time it gets to -10, you should put it on. So this to me makes absolute sense. Whether it's December or January, it really is immaterial. This is either going to happen in December or it's going to happen in January, and then it's every other meeting basically. And the curve, the resulting curve, makes perfect sense to me that that is what the market is looking for. So if the terminal rate is somewhere between 3.5 and 3.75, where are 10s going to be? Are they going to be on top of the terminal rate? No. That totally depends on the term premium, and that totally depends on what the issuance is going to be like. If they move the issuance towards the longer end, we are going to have a steep curve. If they don't, we are probably going to have a pretty flattish curve, say between nothing and 25, 30 basis points between 2s and 30s. Exactly what we have at the moment, really. I don't think that the curve movements from now on are going to be as significant as they have been for the early part of this year until we know what the issuance is going to be like, and there's no chance we find that out before February, and probably no chance that any changes are going to happen until 3 months later, when Besant really has decided what he wants to do. Are 10 days enough for him to decide what he wants to do? I don't know. Maybe he's already decided. But the earliest we can see any change is February the 3rd. Well, the dollar did exactly what I expected last week, and it came back and filled, and I think it's in a mood to stop people out and then go again. So, where would I buy it? I would buy it here, just below 105. And where does that equate to in Euro USD? Well, where are the stops? Well, obviously they're here around the 106.10 area, aren't they? We take out some of these stops, we trade 106.50, 60, and that is a good level to actually reshort the euro, 106.60. But what is even more interesting to me is that the euro Japanese yen is finally turning the 200-day moving average. I think any kind of a rally up to 162.70 is a good opportunity to get short euro Japanese yen. That makes sense to me. I've been looking at this for such a long time, trying not to get buried on the way up. From now on, I'm a continuous seller of euro Japanese yen every time it rallies anywhere near the 200-day moving average. I think the risk reward now is that we trade the 200-week moving average, which is somewhere, as you can see, around the 147 area. This kind of area breakdown after rallies makes perfect sense to me, because one block, the euro block, needs to ease and the Japanese need to tighten. Very, very small tightening, but the interest rate differentials are going in different directions. So it makes sense to me that any rally here is a sell. I have really nothing constructive to say about gold, simply because if I don't see any large moves in the bonds and I don't see any large moves in the dollar, I really can't see any large moves in gold. I've been surprised before by that, but I've got to stick to my knitting. What do I think? I don't know. I think that I would like to buy it, but I'm not sure that buying it here makes any sense. As you can see, these moving averages are turning. Technically, I'd like to buy it down here on a break. I would like to buy this 25.50 level. Am I going to get it anytime soon? I don't know. I would like to see people stopped out and all bearish and then look for a bounce. I doubt we get it. What I do know is that commodities are doing absolutely nothing. There doesn't seem to be any commodity inflation about, and that gold probably should trade sideways until bonds have decided which way they want to jump. And again, the dates, I've given you the dates, and until then gold should really trade sideways, which basically means you should fade either extreme. If it rallies, you should fade it. If it dips, you should fade it too. Naturally, the trend we can see, the 200-day moving average where it is, if we get some kind of a ABC retracement, this kind of area is favored. Would I like to buy it there? Yes, I would. Am I going to get the opportunity? Probably not. One thing that makes me actually think that the easiest thing to do is actually sell puts in gold at the level you want to buy it is DBC and the relationship of DBC to gold. As you can see, DBC is doing nothing at all. But if we have a look at the relationship of DBC to gold, it's also doing nothing, and it's at extended levels. I would like to see a retest of these lower levels just for it to have more room to go higher. It really needs at some stage to test the 200-day moving average, which is, as you can see, quite a bit lower. But if you were to retest this level, it would be no surprise, right? Stop some people out and then go. And what does that tell me? That tells me the dips in gold are probably buy as long as DBC doesn't go anywhere. And DBC is not going anywhere, and it's really not breaking this crucial 2175 level. If it were to break significantly below 2175 and stay there for like a couple of weeks, then I guess you can even get bearish gold. But at the moment, that's definitely not the case, is it? In equities, what I want you to be aware of is how much technology, which is the leading sector in the US, is actually losing leadership. This is NDQ over SPY, basically topped out in this range in August, and it's basically just holding in this range while the 200-day moving average is actually, turning over. QQQ over SPY and all these spreads are exactly the same. It's doing exactly the same sort of thing. And even XLF over XLK is doing exactly the same thing. This to me says that S&Ps can go up very little unless they are led by technology, which is its largest component. And therefore other things need to do the heavy lifting like XLF. But how much heavy lifting can they do? They're already very, very stretched themselves. Don't expect huge Santa rallies because you have to get XLK, you have to get QQQs to do them to be able to get anything at all out of SPY. Doesn't mean that SPY is going to collapse. In fact, it won't. It just means that any Santa rally is going to be very modest indeed. I also want you to be aware that SPY TLT has gone absolutely nowhere for quite some time, and it's actually beginning to lag a little bit. And if you ever look at risk parity, that bounced with the bonds, but it's also very unlikely to go through here. That's another percent. And then it'll come back and then it'll go. So what am I saying? I'm saying that the upside is not huge in SPY, and I don't really see any point in chasing it. Do I think it's going to go down, SPY? No, not really. But I just don't see any point in doing anything in it apart from being equal weight kind of thing. And here is my clean chart with the really important levels. And to me, the key level is 58.65. I just don't see us breaking that level. How do I determine that level? Well, it's the highest close of a wave. And every time we've tested it, we've never managed to break and close below it. There've always been buyers there. And all we've done is really gone a little bit sideways. We are just not impulsive. And the reason why we're not impulsive, I showed you earlier, is that tech isn't leading. And when tech can't lead, the moves can't be that great. So yes, should we be going a little bit higher? Probably. I mean, we've closed the month on the high tick. So it's very difficult to see that we are going to collapse in this chart, because let's have a look at where this is the monthly candle. As you can see, we've almost closed on the high tick, and we have room for another couple of percent max during the course of December on these Bollinger Bands, and it always comes back from the weeklies and the monthly Bollinger Bands. Where are the weeklies going to be? Well, they're going to be 61.20, something like that, probably. But I really can't see that we are going to be a million miles from here when the Fed FOMC comes around. I think we're going to be within 0.5%, 1% of where we are now, simply because there is no impulsion here. And there is zero impulsion in all the foreign markets as well. This is the stocks, we are just bouncing off the support that we have here around the 4700, 4720. It wouldn't be surprising to see it during the course of this month go up to the 200-day moving average, and then we see kind of thing. The Nikkei, same story. It's just bouncing around the 200-day moving average, but all these moving averages are flattening out. So the odds of any kind of impulsive move from the foreign markets that should benefit the US market as well are very low. And when the odds are low, you just go equal weight and move away. I think equities, yes, the Santa rally can be very, very small. I just can't see what is going to lead it, or because I just can't see technology really making a big move. And if I can't see it making a big move, I just go equal weight in the US and leave it alone. And that's precisely what I'm doing. More than anything today, I wanted to give you a flavor of how I'm thinking and why I'm thinking what I'm thinking. Again, I don't think that we are in a position to really move a million miles away from where we are in current levels, simply because I don't think that we have the information that we need to move from here. The term premia and the real rates are going to be decided by things that we are just not even close to receiving, and therefore the moves are going to be fades. I just don't think that the bond market can lead us anywhere at the moment. I think the duration in Germany and the duration in the US are pretty much locked together, which locks the US dollar. It basically doesn't allow it to make big moves to the upside. I think the next big move will be to the upside, but I think we need to wait quite some time. And when we need to wait, what do markets do? They stop everyone out. They look for levels to stop everyone out. So you just have to fade the extremes. We are in a fade the extremes for at least a couple of weeks, I think. Thank you very much indeed, and tweet you tomorrow.